The FOMC holds US rates and indicates 2 more cuts this year. Bank Indonesia holds to protect its currency. Australia's job market is set to show ongoing strength. Japan exports fall amid tariff uncertainty. And New Zealand's economy is set for a Q1 boost. That's coming up in our 5 Things in 5 Minutes on Thursday, June the 19th. And then in our deep dive interview, ANZ Economist Dhiraj Nim analyses the Reserve Bank of India's recent monetary policy clarification that further easing is possible after an oversized rate cut earlier this month.
Markets read that policy a bit hawkishly, not really as dovishly as it sounded on the day of announcement, because bond yields rose on the back of concerns that now next step would be to tighten liquidity.
But first in 5 and 5 with ANZ, I'm Alex Tarrenton for Bernard Hickey. The Federal Open Markets Committee has just announced the Fed funds rate remains on hold in a range of 4.25 to 4.5%. New projections maintained 50 basis points of further cuts expected this year. ANZ head of G3 Economics Brian Martin says the Fed reduced its growth forecast and increased its inflation forecast.
That tells us that the Fed now, having seen the 2 April Liberation Day announcements and the impact that is having on the economy, particularly through uncertainty, has formed an assessment that tariffs are going to be more negative for growth than they thought they were going to be in March. They're going to lead to higher inflation than they had thought in March. And the unemployment is going to be that bit higher. So it's a weaker growth, slightly higher inflation story that we're getting. What it is forecasting is a meaningful deceleration in economic activity, but not a recession. These forecasts are broadly in line with what ANZ is forecasting. Therefore, we won't be making any changes to our forecasts. We think the assessment of a significant slowdown in activity this year, but no recession, is still a reasonable base case to work off.
Shortly after the announcement made at 4 a.m. Sydney-Melbourne time, the S&P 500 was trading up 0.29%. The 10-year US Treasury yield was down 2.5 basis points at 4.36%. The gold price was up 0.06% at $3,409 an ounce, while West Texas Intermediate futures were up 0.17% at $74.97 a barrel. The US dollar index was down 0.23%. The Aussie dollar was up 0.76% at 65.24 US cents, while the Kiwi was up 0.42% at 60.47 US cents. Number 2. Bank Indonesia held its benchmark rate at 5.5% amid an easing cycle, citing a need to support its currency against a volatile backdrop. ANZ economist Crystal Tan says the central bank maintained an easing bias.
The governor indicated that further support to the domestic economy might be needed. So the central bank will be watching for opportunities to lower rates further, and the timing will largely be dependent on global conditions and the stability of the Indonesian rupiah. So overall, given subdued inflation, the weak growth outlook, we continue to expect there will be 2 more 25 basis point rate cuts by the end of the year. That would take the policy rate to 5.0%.
Number 3. Australia's May jobs report is expected by ANZ Research to show a 25,000 employment increase, and the unemployment rate steady at 4.1%. ANZ Group Chief Economist Richard Yetzinger says jobs are holding up during a modest mid-cycle slowdown.
And I think reflecting that, there has emerged some stability in the inflation indicators over the last 6 months or so. The most recent round of activity numbers are a little bit softer, and this is always a bit of a monthly lottery with jobs, but should continue to suggest the unemployment rate is likely to be relatively stable, and that's likely to be the key signal for the bank, I think, that even if the economy is a bit softer, it doesn't look to be weak, and we don't expect them to be in any hurry to cut rates.
Number 4. New Zealand's economy likely continued to grow out of last year's recession. ANZ senior economist Matthew Galt is forecasting 0.7% growth in Q1. That would be the same as in Q4 and above the Reserve Bank's forecast.
We're expecting growth to be reasonably broad-based in this GDP outturn. We saw reasonable results in the partial GDP indicators, so for things like retail trade, wholesale trade, a slower rate of decline in construction is something we're picking, along with a decent lift in manufacturing. So we're expecting to see growth to broaden out somewhat compared to the previous quarter.
Number 5. Japan's export values fell 1.7% in May from a year ago, the first drop in 8 months. While that was smaller than expected, the fall and a widening trade deficit are concerning for Q2 growth, says ANZ FX analyst Felix Ryan.
We already have seen Q1 GDP weaken as a consequence of net exports falling and contracting there too. So it's definitely something that the Bank of Japan will be monitoring closely. And we already know from Bank of Japan commentary that if Japan's growth and inflation forecasts that the bank has not met, then that is maybe a bit of puts a higher bar there in terms of further rate hikes for the time being.
Felix Ryan there. Now in our deep dive interview, ANZ Economist Dhiraj Nim explains why the Reserve Bank of India has had to clarify its monetary policy stance in recent days following an unexpected oversized rate cut this month.
From the GDP and the CPI data, two things are clear. One is that the underlying growth momentum in the economy is not as strong as headline growth suggested. And for the CPI data, that there are chances that inflation will be undershooting the Reserve Bank of India's projections. So when we speak of the GDP data, the Q1 data at 7.5% was much above market expectations, but most of it was because the fiscal patterns of spending on subsidies and tax collections were a bit here and there last year. There was underlying private domestic demand growth was actually much weaker, which I think the Reserve Bank of India has also taken note of. As far as the inflation data is concerned, well, headline inflation was around 2.8% below market expectations. It appears that it can go even lower in June, and there is a bigger risk now that headline inflation will be undershooting the RBI's projections that it laid out in the last policy meeting.
So the RBI announced this 50 basis point cut unexpectedly. I think markets were expecting a 25 basis point cut. What rationale did they give for that oversized cut, given that context?
I'm not sure if a very coherent rationale came out of the messaging that the Reserve Bank of India gave. I think one of the reasons could have been to just bring forward the rate cuts that the Reserve Bank of India thought were essential to support the economy in that accommodative stance that they had, and so that the economy has more time under lower rates for growth to pick back up on the back of monetary easing. But I think that's a part of wishful thinking on me, and I don't really think there was a very clear message as to why the Reserve Bank of India did that. I think the biggest surprise was the change of stance, which implied that the RBI has very limited policy space to support growth if their outlook holds. Now, that's a big if there.
And the RBI governor sort of backed that up by saying there wasn't much space for further easing. How did markets interpret that, and how did that sort of lead to this confusion that people are writing about?
Well, looking in the rearview mirror, I think the markets read that policy a bit hawkishly, not really as dovishly as it sounded on the day of announcement, because bond yields rose on the back of concerns that now next step would be to tighten liquidity, because so far liquidity in the banking system was in a large enough surplus that kept the overnight call rate much below the repo rate. And now the market feared that maybe the Reserve Bank will bring it closer to the repo rate. That means that stealth 20-25 basis point cut, which was happening on account of large liquidity, might just go away. So I think markets in overall terms took the policy as a bit hawkishly than, of course, was intended.
What do you think the governor was trying to achieve with that recent interview, noting that policy space could open up, and how have markets reacted to that?
I think there's not much of a market reaction right now because some of the global cues are dominating. For example, oil prices and where the dollar is headed, all of that is a bit dominant in the market narrative right now. But to be fair, look, the Reserve Bank of India and the Monetary Policy Committee, of course, they are in the neutral stance. Now, in neutral stance, they have the flexibility to go either way. They can just keep the rates on hold if they so think is required for the economy. They can cut as well if they think that conditions are okay for them to ease the policy further. Now, what we were thinking is that any further rate cut now will be predicated on growth conditions. And we think that the Reserve Bank of India's confidence on growth will get tested because there is no clear indication that growth is going to hold up at 6.5% in FY26, especially in a very challenging global environment. But what the governor has done is put another dimension to it, that they will be willing to consider additional easing if inflation is lower than their projections. I think the odds of that happening are quite high. Our baseline assumption is one more rate cut, and we are thinking that it can happen in Q4, whether October or December, depending upon data. And it would largely be guided by the fact that growth is turning out to be weaker than the Reserve Bank of India thought.
Dhiraj Nim there. I'm Alex Tarrenton for Bernatiki. That was 5 and 5 with ANZ for Thursday, June the 19th. Catch you tomorrow with the Bank of England's latest rate decision, expected by ANZ Research to be on hold.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.